Alright, welcome back guys. So today I'm going to show you this powerful liquidity strategy. So very simple and precise, not much. Is as simple as you can take. You just open your minds and you understand. So this is an opportunity on gold today that you could have capitalized using this strategy. So first of all, the strategy also, as you know, the trend is your friend. Always go with the trend. So you go with the trend, but you are looking for the most recent low or high or liquidity to be taken before you look for an entry. So you mark your areas of concentration. So when price comes you to those areas, most especially when liquidity is swept, those are areas you are going to target. So now from the 4 hour time frame, we can see clearly that price is in an uptrend. From the daily, look at it from the daily, you can see price making higher highs and higher lows. You can see price is making higher highs, higher lows, higher highs, higher lows. So price, we are expecting price to make another higher highs. So this is the trend from the daily time frame. Alright, so coming to the 4 hour time frame now, you can see now that price is in an uptrend also on the 4 hour time frame. You can see price has broke this high, price broke this high, and price is now bullish to the upside. So we are targeting the overall high here on the daily time frame. So knowing this, you can now go to lower time frame like the 1 hour. Also in the 1 hour, you can see that the trend is also bullish. You can see the 1 hour time frame is also bullish. You can see price is going straight to the upside. Price is going straight to the upside. Can you see? So this is an uptrend. So now seeing this, you can now move to 15-minute time frame. 15-minute time frame. Since you now know that okay, price is now bullish, price is now bullish, and this is our New York session here. So you go to the 15-minute time frame. In this 15-minute time frame, this is a place where you start looking for your liquidity areas. So around this candle here, this is 12 o'clock, this is New York open, this candle here. So from here now, you will now mark the recent low. This is the most recent low here. This is the most recent low, and beneath that low, what do you see? You can see is a demand zone here. You can see, you can see this is the most recent zone, and beneath this liquidity, there is a demand zone here. So this is a place you can take your entry. Then what do? You go to the 1 minute time frame, or you can go to the 5 minute time frame, whichever time frame you want. You can go to the 5 minute time frame. So immediately price sweeps this area of liquidity here. Immediately price sweeps this area of liquidity, this door. Price taps here, and you can see price starts giving some rejection. So when you see this rejection, this pattern here, you can take your entry here, and your stop loss should be below this overall low, this entire demand zone. So you can take your entry here. So this is the entry on the 5 minute time frame. So if you want a better entry, you can go to the 1 minute time frame. You can go to the 1 minute time frame. So now this is the 1 minute time frame. You can see immediately price swept this low here. What happened? Price went up aggressively. And look at liquidity areas. Price came back and swept this low again. You can see price took out this low again. Immediately price takes out this low, price started rejecting to the upside. So what are you waiting for? We are waiting for price to show us a sign of bullishness.
So immediately price came here, took out this low, came here, came back again, created another liquidity. So immediately price sweeps this liquidity. What happened? You can see immediately price sweeps this low here. Price made an aggressive push to the upside. Price came and broke this high. Immediately price broke this high here. This is a point where you start looking for your entry. Immediately price takes this high. What do? You can see after it takes the high, it left an imbalance here. So around range zone, when you see this rejection, this is where you take your entry. On the 1 minute, your stop loss should be below, and it will give you a higher risk to reward. So this is it. Then we can go to, if you miss that setup, then no problem. This is another setup again on the 15-minute time frame. You can see this is a liquidity area. You have to wait for the most recent liquidity area to be swept first. So after price swept this liquidity area, what do we see again? We saw a fair value gap or an imbalance around this zone. You can see. Then beneath the liquidity and the imbalance here, we have a demand zone. This last red candle before the push. You can see. So immediately price reach this point, what do? You go to your 1 minute time frame also. Now on the 1 minute time frame, you can see this is the point at which price taps this zone. So what do? You now wait and look for your confirmation. Price tapped here, went up, came here, created this low again. You can see on the 1 minute time frame, price came back, swept this low. Immediately it swept this internal low here. You can see this internal liquidity here. Price swept this internal liquidity. Let me mark it so that it will be clearer and bolder. So you can see immediately price took out this liquidity here. So what do we see? Price took out this liquidity area here. Immediately price took out this liquidity area, price broke this high. Immediately you see price breaks this high here. Let me mark the high carefully. So you see, so immediately price took out this high. What do we see? Price broke out this high, left an imbalance around this zone. You see an imbalance here. So what do? You can now mark the imbalance here. This is it. Price left an imbalance here. So you can see. So immediately price came back here to this point of imbalance and rejected here. This is where you enter and you target what? The overall high. You can see. You can see the move. So this is how to trade liquidity. So if you have any question or comment, so write your comment in the description below and follow and like for more. Thank you.